Financing options and your credit. Well, now that you've found that perfect used car that's just right for you, how are you going to pay for it? In this segment, we'll look at the different options you have for paying for that new used car or truck. First of all, it's extremely important that you understand just how important it is to protect your credit rating. The economic structure within the U.S. demands that you have good credit. And those individuals who do have marginal credit, who do manage to get financing for their vehicle purchase, typically find themselves paying a substantially higher interest rate, which means much higher car payments than those who have good credit. When you wish to purchase a used car that costs quite a bit more than you have cash for, you'll want to finance it. Now, whether or not you decide to finance through your local bank, credit union, or a car dealer will depend on how good your credit is and if, once again, you do your homework by shopping for the best interest rate. Remember, the lower the interest rate of the car loan, the lower your monthly payment. Now, many dealers can offer you the convenience of one-stop shopping and can offer you competitive interest rates and help you do all of the paperwork right there at the same time as when you buy the car. Now, for those customers who have credit that's, let's just say, not so good, there are dealers who can offer what is known as buy here, pay here options. In other words, the dealer becomes the bank and the customer makes payments directly to the dealer. Now, the customer traditionally pays a higher interest rate for this service. Now, what determines the type of loan you qualify for and the interest rate you receive on your car loan is typically the FICO score. Other scoring systems are called Beacon and Empirica. Now, these credit scores they all use a formula developed by Fair Isaac and Company. It's basically a method of determining the likelihood that credit users are going to pay their bills. Your FICO, Beacon, or Empirica score is determined typically by late payments, the amount of time credit has been established, the amount of credit used versus the amount of credit available, a length of time at your present residence, negative credit information such as bankruptcies, any charge-offs. In other words, you didn't pay anybody, you didn't pay off your last bill, any collections, and any other negative reports about your credit. Other factors taken into consideration include your income, how long you've worked at your present job, and the kind of credit you're requesting. Your car dealer, bank, or credit union will most likely use one of the three credit bureaus, Experian, TransUnion, or Equifax, to review your history to see which finance rate you qualify for. Nothing can be as heartbreaking as to find that perfect used car, the one you've been dreaming about, the one you just drove and want to take home and then being told, you don't qualify for financing. So how do you prevent this from happening to your dreams? Well, for starters, pay your bills on time. Don't apply for credit frequently. And reduce your credit card balances. And if you have limited credit, obtain additional credit. Now, your credit information is critical to your future. Protect it and protect your personal identification. Never, and I mean never, share your Social Security number with anyone on a casual basis or over the internet unless it's a secure site and unless it's for government purposes. Now, once an individual has your Social Security number, driver's license number, and your birthday, the doors of chaos are open and extremely difficult to close. Your bank, credit union, or car dealer can also help you with some of the valuable products that are available to people who finance. For example, one of the products you most definitely would want to get is called gap insurance. For example, did you know that when you finance a car and you have it insured, let's say you finance it for 4 years, and you have an accident within the first year, your insurance company will write a check, but that check will pay for the value of the car only. Remember, you still have a loan on that car. The loan amount, because it has interest in it, will exceed the value of the car. What that means is your insurance paid off the value of the car, but it did not pay for the value of the loan. That means there's a gap in there. Unfortunately, many people still find themselves making payments on a vehicle that doesn't exist anymore. You actually have the option of purchasing something called gap insurance, which makes up the difference between the value of the car when it's involved in a total write-off and the value of the remaining balance of the loan. Well worth investigating and well worth purchasing. You have credit life insurance. That's in the event of a death of an individual. The loan is paid off. You can get accidental health insurance in case you're involved in an accident. You can't work, make payments. So there are products like that are available which you might want to consider attaching to your car payment loan.